Okay, so we're going to do some multi-time frame analysis, which always starts on the higher time frame. That's absolutely key. The higher time frame, there's essentially three higher time frames. You've got the weekly, the daily, and the 4 hour. Crucially, you don't have the 1 hour. The 1 hour chart is not a higher time frame. Don't make that mistake because I made that mistake quite a lot. Like a 1 hour high or low isn't that important, but a 4 hour high or low is a lot more important. But yeah, for multi-time frame analysis, what you really want to do is you want to mark out your key levels on the higher time frames, so the weekly, the daily, the 4 hour, and then you want to transpose it, which essentially means you keep it on your charts. And then depending on what time frame you trade, so for me it'd be the 4 hour chart, you just target those key levels that you have on the weekly and daily, and even the 4 hour itself. And then if you're a scalper or a day trader, you also target the 4 hour, the daily, and the weekly key levels. Not the intraday targets, unless sometimes you can do like the session, like highs and lows. That's why day trading and scalping tends to be quite difficult for beginners. So I'd recommend if you're a beginner, just stick to the higher time frames because it's just easier because you still have to do the exact same analysis that you would do if you were a swing trader, but then you've also got to do a bit more analysis on the lower time frames. But yeah, so all analysis starts on the weekly chart. And the key thing you want to do, as always, is just target highs and lows, right? You want to think, where is the most obvious liquidity on the chart? And if you look here, right, see how we've been in like a bit of a bullish move. The most obvious liquidity that I can see is this high here. So let's just mark it out. This key high right up here has a lot of people who've shorted the euro. And now that we've been on a bullish trend, so you see how we respected this order block here. We respected this order block again. We've gone up. This is the most obvious liquidity pool. So what does that mean, right? That means that the highest probability is going long in the euro. But what will confuse a lot of people, and what confused me for ages, is that even though price wants to go up, it will still go down. Because remember, we're on the weekly. Let me just make this a bit bigger. We're on the weekly chart here. So each of these candles is a weekly chart. And you see how we have this large down close candle here, and even this wick here. If you were going long, and you'd be correct, right? Because we're bullish, you'd lose. Like you'd lose quite a lot. So the lower the time frame you get, the more manipulation you get. So the more times it will go against the weekly and daily bias, which makes it quite difficult. But the highest probability is always in the higher time frame. And then what you want to do is you want to go from the weekly down to the daily. Just sort this out. And then you want to keep the exact same levels, right? Keep the exact same levels on your chart. And then you want to study the daily a bit more closely. So you see how we've gone up, right? And here's another key thing. If price wants to go up, it doesn't move in straight lines, right? So price will often have retracements like you can see here. Retracement here, retracement here, retracement here before it goes up. And you don't want to get caught up in these little retracements because trust me, it's not that good. But this is where a lot of new traders struggle is with these daily candles because you'll have the daily bias right, the weekly bias right, but you can still lose and price will still go against you, which I hate. But yeah, the higher the time frame, the less likely you are to experience that. But if we just study the daily chart here, right, see how we've had this retracement into this order block here. I'll just mark it out with this gap here. You see this order block here, we've wicked in a bit and we've quickly shot off. So what does that mean, right? That shows us that we're still bullish. That's what they call bullish order flow, right? Institutional order flow. It's still bullish, which means the highest probability is going long. So I'll just get rid of this order block here. So you got to think, right? As always, you want to target highs and lows, and because we're bullish, you don't want to target any lows. And if you look a bit carefully, you see this low here, we've already taken out. So that's the take of liquidity, which means we're very unlikely to take this low out again. So what you want to do is you want to mark the key high on the daily chart here, right? This is the most obvious liquidity that we're going to go for next. So that's your target on the daily chart. And if you remember the weekly chart objectives here, but that's more of a longer time frame. And it's not that important because we're not there yet, if that makes sense. But the higher time frame order flow is still bullish. And then from the daily, you want to go to the 4 hour chart, like this. So for me, I just trade the 4 hour chart. So what I would want to see for me to enter is I'd want to see us go a bit more up to this wick and leave either relative equal highs or just show complete disrespect because that's what you want to see, right? If you're bullish, you don't want to see price keep respecting these order blocks here and here. You don't want to see that because that shows you that you might still be bullish, but price is quite choppy and stuff, and you don't want to get caught up in that. Yeah, so with the 4 hour chart, right? Now you've got a lot of key liquidity. This is very important. The 4 hour chart will give you key liquidity intraday. So if you're a day trader, and it will give you key targets if you're like a swing trader, short-term trader. If you trade a daily chart like a proper like swing trader would hold for maybe like a month or so, you don't really want to look at the 4 hour chart. But for most traders, the 4 hour chart is ideal. Um, yeah, what happens on the 4 hour chart tends to like direct the market for like the next week, essentially. So we have this order block here. See this order block here, a lot of fair value gaps here, but we have this key liquidity up here. Let me just make that a bit clearer there. This key liquidity up here. So the highest probability trades is going long, right? It's going long straight to here. But what you could see, and this candle hasn't closed yet, by the way, so this isn't a fair value gap, but it probably will close and make it a fair value gap. But do not mark it out as a fair value gap until you get the candles to close. Yeah, that's very important. Don't do that because I've made that mistake quite a lot, especially if you're a scalper. Always wait for the candles to close. It's absolutely crucial. But what we do have is we have an order block here and a fair value gap here. I know we've got another one, we've got another fair value gap here, but this is more important because we're more likely to retrace into here than there. And if you get the Fibonacci up, right, this is the 50% level. So this is a discount. Now discount essentially means it's cheap, right? It's not the right word, but you can kind of like picture what I'm trying to say. It means it's cheap. It means it's a good place to buy, and more importantly, it means it's a good place to buy for like big institutions. But that once it gets to the 50% level, like algorithms and alerts will start triggering, and then people will start buying because for them that's how they classify it as like cheap essentially. But you don't need to know that. All you need to know is that around the 50% level with this fair value gap, so price could retrace into here and then go up. And that right there is what makes trading so difficult, right? Because we've done the analysis, we know that we're bullish. We know that the highest probability is going long, but price can still go down just to go up. This is what makes trading so hard, right? So we've determined that we're bullish. There's two things that could happen. The first is this, right? Like this. We retrace into this fair value gap, maybe this order block here, and then we shoot back up. Now remember, this is the 4 hour chart. So if you're a day trader, like every 4 hours a session essentially. And if it's going down, you can trade that, but that's more lower probability. And if you don't want to trade that, then you're gonna have to wait for maybe even a week or at least a few days just to get it into the fair value gap, which is where it's likely to go. So that's what price could do. And if you start seeing price retrace, even though we're bullish, always look for what PD arrays are going to. PD array is essentially an imbalance. So you've got a fair value gap and you've got an order block. Those are the two things that you need. You don't need breakers or mitigation blocks. You don't need any of that. Just fair value gaps and order blocks. So essentially if price is going against your bias, always look for, is it going to go to a fair value gap or is it going to go to an order block? Always look for that. So what you can have, right, is as we've determined we're bullish, price can retrace into the fair value gap and then shoot off straight for the liquidity. So if you're a short-term trader, right, and this is where the optimal trade entry is so good, because for me, I'd be entering around here. So if we get into the order block, like this, enter to 3 to 1, like that, and then target these highs. That's what I would be doing. And yeah, I just think that's so much simpler, right? Because if you're like a swing trader, short-term trader, right? You've done all the analysis now. All you've got to do is just wait for the retracement, right? That's it. That's it. You're done. But if you're a day trader or a scalper, we're gonna have to do a bit more analysis, and then you're gonna have to keep these key levels. So do you remember how I said there was two things that could happen, right? The first was this retracement that we've had. The second is that price just shoots straight up and then comes down. Yeah, and you never know which one's gonna happen. Those are the two things that can happen. So yeah, it's almost like a 50-50. This is why if you're a scalper or a day trader, you're gonna need to wait for confirmation. You can't just blindly, even though we're long or bullish overall, you can't just blindly buy. You have to wait for confirmation. So what does confirmation look like, right? Now we start going down to the lower time frames. Um, I'm just going to mark up this high here, right? I'll go on the hourly chart to make it a bit more obvious. This is just a key liquidity intraday. It's not a higher time frame liquidity, right? Because we're on the hourly chart. But it's a reasonable, realistic target that we could have intraday, right? I hope that makes sense. That we could hit this intraday. That's why I've marked it out. Because there's no point having. I mean, you should keep these daily levels on, but We're not going to hit this in a day, are we? But we might hit this one in a day, or at least draw to liquidity. And this is very important, right? So people call this a drawn liquidity. What that means is that price will often go to highs on those, and it won't always take out the high, right? This is very important. It won't always take out the high. Sometimes it will leave it there. So it might leave this high in place just to create more liquidity, right? Because it might leave this high in place and then go to this fair value gap. And if it does that, a lot of people are going to start shorting as it comes down and put their stops here because they think it's a good resistance level, right? You know, supply and demand. That's what they would think. So price could either do that or it could shoot straight through it. But if you're a day trader, so let's get down to the 15-minute chart. So if you're a day trader, right? It's very reasonable and realistic that price is likely to draw up to this level. It might not go for it, but it's likely to go up towards it. And at this point, because you're a day trader, you want to look for your entries. I'm on the 15-minute chart now because when I was a day trader, I prefer the 15-minute chart because it's so clean and it's what I would recommend to you. If you were to trade 15-minute chart, what you could do is you could have this order block entry here. But this is the thing with day trading. Like even though you're right, and let's say you enter at this order block, yeah, let's get the wrist tool. Let's say you do the body as well, and let's say you put your stop here, or even here. But it's realistic that you'd actually put it here. So you aim for that. You get 3-1, but it's also very likely that price can just do that. You know, especially as you're a day trader, go straight into this fair value gap and go off without you. And this happens to me so much. This is why I stopped day trading and scalping. You'd be right. You do all this analysis. You'd be completely correct where price is going to go, and it'd come down, take out your stop loss, and then go straight up without you. Which is just day trading. But the higher time frames you are, the less likely you are to get swept. That's what this is called, by the way, a liquidity sweep, where it comes, takes you out, and goes straight up without you. But let's just say, let's say you want to trade the 5-minute, right, instead of the 15-minute. A bit more of a scalper. If you go on it, you can get there's fair value gap entries here. This is called an order block, by the way. Not an order block, sorry. A volume imbalance. See this bit here and this bit here, these two wicks. It's called a volume imbalance. It's essentially like a like a poor man's fair value gap. It's like a weak fair value gap. They tend not to hold a lot, but price does draw into it. But yeah, you can enter at any of these fair value gaps, which is what I'd recommend. I'd recommend fair value gaps for scalpers because I think they're just they're a bit there, but you've got to be quite fast when you enter. So here's a fair value gap. You have to put your stop at the minimum at this candle here because this candle caused the fair value gap. Right, that's like the minimum. Some people would put it here, but assuming you're a scalper, if you're a scalper, you probably aim for a 2-1, I'd say, or even a 1-1, which you would get. You would get a high probability scalp during London. But yeah, that can get you a simple 2-1, and essentially that's all you really need to do. That's multi-time frame analysis. The lower the time frame you get, the more unpredictable price gets. Because let's say even though you're bullish on the higher time frames, price will often go against you. Like intraday, it will just retrace. Which is why I don't really like the lower time frames. But you can get high probability setups. The thing that people do who are like day traders is they tend to aim for like 4-1s, 5-1s, which I don't like because you tend to have a really low win rate. But you know, each their own. If that works for you, that works for you. But that's how you use higher time frame analysis. And yeah, it's what you really want to do, right? The weekly just gives you the overall trend. Look at it that way. So look how messy this is already. The weekly gives you the overall trend. So we know we want to go up there to this high. That's like the higher time frame bias. That's where price is most likely to grow up to. But if you're a day trader or even a swing trader like I am, the weekly candle's so slow. And here's another thing that I forgot. Remember, you're not trading the weekly candle. Yeah, you're not trading the weekly chart. You're trading whatever time frame you are. For me, it's the 4-hour chart. For you, it might be the 15-minute, the 5-minute. You're not trading the weekly chart. Just remember that price will draw up to these levels. It's higher probability that it'll go up. But you want to put more emphasis on the liquidity that's closest to you. So if you're a daily trader, let's say you trade a day chart, and you just take like an optimal trade entry like this, you want to be prioritizing this time frame, the daily. Now, why can you prioritize the daily chart if you trade the daily time frame? Because it's a higher time frame, right? And do you remember how I said right at the beginning of the video, there's only 3 higher time frames: the weekly, the daily and the 4-hour chart, not the 1-hour chart. So for me, right, do you know how I said I trade the 4-hour chart? Yeah. Because I trade the 4-hour chart, I can just look at liquidity on the 4-hour chart. Like I can just trade the 4-hour chart alone. I don't really need to use the higher time frame analysis because I can see the higher time frame liquidity that's most likely to be drawn to, if that makes sense. Whereas if you're on the 15-minute, 5-minute, or even the hourly chart, that isn't a higher time frame liquidity. Yeah, so you have to use the higher time frames. And the higher time frames are the 4-hour, daily, and the weekly. So always remember that. Always remember that. Because when I used to trade the 5-minute chart, like I would just mark out like highs and lows. Literally like this high here. So I'd mark out this high here and then this low here. Like I had no idea what I was doing. But you have to have the higher time frame just liquidity and also these fair value gaps marked out. That's absolutely crucial to profitability. It's absolutely crucial. But yeah, this is why I think if you just trade the higher time frame, you don't need to go lower. But if you do want to go lower, make sure you keep the higher time frame levels on your chart. And always, 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 please always do this. Always take them as precedence over your time frames. And let's just say you still want to be like a scalper and day trader. Always, always, always prioritize the higher time frames. Always prioritize them for liquidity because that's where price moves, right? Whoever moves price, whether you think it's an algorithm or, smart money, large funds, they operate at a minimum the 4-hour chart, right? They execute their orders on this chart, and then they do their analysis on the weekly and the daily, right? So I essentially just told you. Let's just remove all these levels. I essentially just told you this is what they do, and in fact, they even use the monthly chart, too, which we're not going to talk about because it's way too slow. It's way too slow. The monthly chart, but they will look at the monthly chart. They'll look at the weekly chart, and they'll see this. They'll see this key liquidity here, and they'll look for any sort of buying opportunity on the way up to that key level. Then they'll look at the daily chart for their analysis. They'll see this order block or supply zone, demand zone, whatever you want to call it, and then they'll start buying here. And then on the 4-hour chart, they'll be buying any sort of retracement here. So let's just get the any sort of retracement here they're buying like that, and then they're going to ride it all the way up. We have left that level off, but you guys get the point. They're going to ride it all the way up to this key level that we've marked out on the weekly chart. And then once we hit this level here, they'll wait. They won't trade. A lot of traders, retail traders, will still scalp, still day trade. They will wait for maybe like a week and just see what we do. Because if you look to the left, you have an order block here too. So it's very likely that price will just come up, take liquidity out, and then just consolidate for a bit like that. And then who knows? It could go up, it could go down, it could do anything. That's how price tends to work. But yeah, the higher time frames set the precedence for everything. I hope that makes sense. The higher time frames, that's what you want to use, and then you just use whatever time frame you trade just to target those higher time frames. But yeah, I hope that was useful. I did ramble on quite a bit, but I hope it's clear to you all. And yeah, please like the video and subscribe, and yep, I'll see you tomorrow.